Have you ever drawn a perfectly straight support line on a chart, only to watch the price drop right through it like it wasn't there? Standard support lines often fail because they are too thin. Trying to pinpoint a reversal to the exact penny overlooks the reality of how the market actually moves. The stock market is driven by massive institutions. We're talking about banks and hedge funds placing trades worth tens or hundreds of millions of dollars at a single time. Orders of that size are simply too massive to be filled all at once at a single precise price point. Instead, they have to be spread out over a wide range of prices to get fully executed. To reflect this reality, we have to take that single price point and stretch it out into a thick, realistic rectangle. Identifying these safety nets built by institutions, known as supply and demand zones, is the key to navigating the market's volatility. To actually use one of these safety nets, we first need to know exactly how to spot them on a chart. This chart shows price moving sideways, the base. Here, institutions secretly buy shares, accumulating massive positions. Then, the price suddenly and violently explodes upward, the strong departure. A demand zone requires both elements. We mark it by drawing a thick rectangle starting from that base. There is one important rule to remember here. The larger and faster those green candles shoot upward, the stronger your zone will be. By finding this specific two-part pattern, you are pinpointing the exact territory where a bank or a hedge fund just placed a massive bet. Let's imagine it's a few weeks later. The stock has peaked, and the price is slowly drifting back down toward that thick zone we drew. When the initial explosion upward happened, those institutions couldn't fill all of their massive buy orders. That means there are still millions of dollars left over, waiting right there at the base. This chart illustrates our three-step strategy in action. Step 1 is simply to wait. We let the downward moving red candles drop fully into the demand zone without trying to catch them early. Step 2 is to confirm. Inside the zone, we look for a small green candle to form. That little upward bump proves the big buyers are waking up, and our safety net is holding strong. Finally, step 3 is the ride. You enter your trade safely inside the zone, allowing you to ride that new wave of institutional buying as the price pushes back up. This step-by-step strategy turns a price drop into a calculated entry point, using that massive institutional scale as your personal backstop. Now, everything we just learned works exactly the same way in reverse, acting as a ceiling to keep you from buying at the wrong time. This chart displays exactly that. A high base followed by a rapid, aggressive drop. That generates a red supply zone, working as a thick ceiling above the current price. These supply zones mark areas where institutions dumped massive amounts of shares. If everyday traders try to buy as the price reaches that ceiling, they get trapped by those leftover sell orders. There is one detail to watch out for. A brand new zone is incredibly strong, but if the price bounces off the same zone 3 or 4 times, those waiting orders eventually run dry, and the zone will break. A real market edge comes from reading institutional footprints, waiting for their nets, and letting that massive capital do the heavy lifting for you.